Good morning, students. I welcome you to another session on auditing. In this session, I will discuss assertions. All right. So assertions are important. In fact, an audit is largely about checking assertions. But what actually assertions mean? Let's see. Now, assertions are explicit or implicit representations that are made by management that are embodied in the financial statements. So these are the representations by management and are in the financial statements, and these may be explicit or implicit. So management states a lot of things. They state a lot of things in financial statements. And when they state items, elements in financial statements, they make representations. Such representations may be explicit or implicit. So these representations are in the financial statements, through the financial statements. For example, management states that value of property, plant, and equipment is $90,000. So management states in balance sheet property, plant, and equipment at $90,000. Now, what does this mean? What representations are made by management through this? What management is representing? So management is stating certain things through this. What management is stating through this? Management is stating that they have property, plant, and equipment. They actually have it. That is existence assertion. That property, plant, and equipment exist. This is a representation that management is making. So when management states property, plant, and equipment in the balance sheet, they make an assertion. They make an assertion that, yes, we have property, plant, and equipment. They make an assertion that its value is $90,000. So again, they make another assertion, that is valuation assertion. That yes, we have property, plant, and equipment. That is the existence. And the value of that property, plant, and equipment is $90,000. Valuation assertion. Its value is correct. The value that we have reported, $90,000, is correct. The value of property, plant, and equipment is not less than $90,000. Is also not more than $90,000, but is $90,000. This is what management is stating. This is what management is representing. When management states property, plant, and equipment at $90,000 in balance sheet, it makes an assertion that it is complete. We have not missed any item to be reported in the balance sheet. We have reported all property, plant, and equipment that we have. Completeness assertion. It makes an assertion that they actually own this property, plant, and equipment. It is not rented. That they own it, they control it. So they make various representations that may be explicit or implicit. Explicit, when they say property, plant, and equipment, $90,000, this is an explicit representation. They are explicitly stating it at $90,000. They are stating that its value is $90,000. But they are also implicitly representing that they own it. Management is implicitly representing that they control it. They have the rights and obligations. They have the rights regarding this. All right. All right. Now, these assertions, which may be explicit or implicit, which are made by management, which are embodied in the financial statements, may be classified into three categories. That is, assertions about classes of transactions and events. For example, they make assertions regarding sales transactions, purchase transactions, interest payment transactions, dividend transactions, issuance of common stock transactions, treasury stock transactions. So they make representations, they make assertions. What are those assertions? I will discuss in a moment. They make assertions about account balances regarding assets, liabilities, and equity. So they make assertions about account receivable, they make assertions about accounts payable, property, plant and equipment, inventory, intangible, bank loan, any item of, in fact, every item of asset, liabilities, and equity. They make representations. They make representations regarding presentation and disclosure. That disclosures are complete, they are properly presented. We will discuss these assertions in a moment. So these assertions may be classified into three categories: assertion regarding transactions and events, assertions regarding account balances, assertion about presentation and disclosure. All right. And you guys know that these assertions are representations by management. These are included in the financial statements. These may be explicit or implicit. And auditor checks these assertions. Auditor checks whether the value of property, plant, and equipment is really $90,000 or not. The auditor checks whether this property, plant, and equipment actually exists in the factory or not. The auditor checks whether all the property, plant, and equipment is reported by management or not. The auditor checks whether organization actually owns that property, plant, and equipment or not. So auditor checks those assertions. All right. So there are three categories of assertions: assertions about classes of transactions and events, assertion about account balances, and assertions about presentation and disclosure. Let's start with assertion about classes of transactions and events. So regarding transaction and events, management makes certain assertions. Now, what assertions management make regarding transactions and events? For example, management states that sales for the year are $500,000, let's say. And this they are stating for year two. This they state in the income statement for year two. So in income statement for year two, they state sales at $500,000. When they state this, they are making certain representations. They are making assertions. These representations may be explicit or implicit. Now, what assertions management is making regarding classes of transactions and events? They're making 5 assertions. First is occurrence assertion. So when management states sales at $500,000 for year two, they make an occurrence assertion, that is, all the sales have actually occurred. It is not that we are showing fake sales. Occurrence, these sales have actually occurred. It is not that sales are somewhere around $400,000, but we are stating sales at $500,000. No, sales have actually occurred. All the sales pertain to the entity. When management states sales at $500,000, they make completeness assertion. That is, no sales are missed. So management states that we have included all the sales in this figure. It is not that we have missed any sales figure. It is not that our sales are more than $500,000, but we have reported only $500,000. It is not that this sales figure of $500,000 includes only domestic sales. No, it includes all sales. It is complete. It is not that this sales figure of $500,000 includes sales at selected locations. No, this sales figure is complete. That is, no sales are missed to be reported. This sales figure of $500,000 is complete. When management states sales at $500,000 for year 2, they state that this amount is accurate. It is correctly computed. Cut off. Management makes a representation that sales are recorded in the correct accounting period. It is not that this sales figure of $500,000 includes sales for year 3 or sales for year 1. No. This sales figure of $500,000 includes only sales for year 2. That is correct accounting period. This sales figure is for the correct accounting period. This sales figure is for year 2 only. All right. When management states sales at $500,000 for year 2, they make a representation that sales are properly classified. They are correctly recorded. When we say sales of $500,000, this includes sales of our goods, sales of services. This does not include sale of property, plant, and equipment. So classification is correct. Management make representations regarding transactions and events. Management make representation regarding account balances. Let me give you an example. Suppose management states that inventory balance is $100,000. This is at the end of year 2. All right. So management states this in balance sheet. And when management states this in balance sheet, management makes certain representations. It makes representations regarding existence, completeness, valuation and allocation, rights and obligation. So what representation management is making? Management is making a representation that inventory actually exists in warehouse. It is not that we have reported inventory, but we don't have those inventory items. Inventory exists. If we say that we have 500 inventory items, we have those 500 inventory items. Those are in the warehouse. This is what management is saying when they are stating inventory, that we have these 500 items and these are in the warehouse. That inventory actually exists. It is not that we have reported fake inventory items. It is not that we only have 400 items, but we have reported 500 items. No. We have inventory and we have inventory of 500 items. Completeness. That is, there are no misses. We have reported all inventory that we have. If we have inventory at 5 locations, we have included all the inventory. If we have inventory of 500 items, we have reported all 500 items. It is not that we have inventory of 700 items, but we have reported inventory of 500 items. No. It is not that we have inventory at 10 different locations, But out of those, major locations are 8. So we have reported inventory at those 8 major locations? No, we have reported inventory at all 10 locations. It is complete. There are no misses. When management says inventory is $100,000, they make a valuation assertion. That is, inventory is reported at correct value. If management reports inventory at $100,000, this is the correct value. It is not that inventory value is very less, inventory is obsolete, inventory is not sellable, inventory is in a bad condition. Because of this, value of inventory is only $40,000, but management still reports it at $100,000. No. When management says that inventory is $100,000, they make a representation that value is correct. Its value is $100,000. If inventory had to be valued at lower of cost or market, for example, if lower of cost or market had to be applied, that is applied, and we have reported inventory at lower of cost or market value. If certain adjustments are to be done, those are done. If any loss on inventory had to be recognized, that is recognized, and it is reported at correct value. When management reports inventory at $100,000, it makes representation that whatever inventory we have reported, we own it. We control it. We have the rights to that inventory. For example, if the entity is a consignee, so it receives goods from consignor, but only in the custodial capacity, only as an agent. So if it receives 70 units from consignor, those 70 units are in the warehouse, but management states that we have not included those 70 items when reporting inventory because we do not own it. This is what management is stating. Management is representing. Management is asserting. Management is asserting that whatever inventory that we have reported, we have rights to that inventory. We control that inventory. It is not that we have included goods received from consignor also in this inventory. No, we have not done that. If we hold goods on bill and hold arrangement, so suppose if entity holds goods on bill and hold arrangement. What is bill and hold arrangement? Under this, you bill the goods to the customer and transfer the control of the goods to the customer, but customer does not pick those goods. Those goods are still with the entity under the bill and hold arrangement. So customer will pick up those goods as per the terms of the contract, but at a later time. But as of now, entity has billed the customer and holding those goods only in custodial capacity. So although such goods which are under bill and hold arrangement and which have been billed are in the warehouse, but does the organization control those goods? No. Does the organization own those goods? No. Does the organization have the rights to those goods? Answer is no. So should those goods be included in inventory balance? Answer is no. And management asserts that yes, we have not included such goods. We have not included goods which we have received on consignment. We have not included goods in our inventory balance which are billed under bill and hold arrangement. We have not included those goods. That is what management is representing. So it is stating, management is saying that whatever we have reported, we own. We have the rights. Now, management make assertions about presentation and disclosure. So when management presents and discloses information, there may be implicit or explicit representation in those disclosures. What representations are there in disclosures? Occurrence assertion. That is, transactions have occurred, pertain to the entity. Rights and obligation. So if the disclosures relate to assets and liabilities, yes, they have the rights and obligations. Completeness. No disclosures are missing. Disclosures are complete. Disclosures are reported at correct amount. Information is presented clearly and properly. So when management makes certain disclosures, management make representations, explicit or implicit. And these assertions relate to occurrence, rights and obligations, completeness, accuracy, valuation, classification, and understandability. All right. So management makes various assertions and auditor checks those assertions. Management states that value of inventory is $100,000. Auditor will check that. Management says that we had purchased goods worth $20,000 during the year. Auditor will check that. Management says that our interest expense for this year is $15,000. Auditor will check that. Management states that value of property, plant, and equipment is $90,000. Auditor will check that. So auditor checks assertions. Assertions are important from an auditor's perspective. Now, auditor is primarily concerned about relevant assertions. So management make a lot of assertions, but it is not that every kind of assertion is relevant and important to the auditor. Auditor has to see what all are relevant assertions. So if assertion is not important, auditor will not spend that much of time and effort in verifying that assertion. Auditor is primarily concerned about relevant assertions. Now, what are relevant assertions from an auditor's perspective? Let's read. So assertion that have a reasonable possibility of containing a misstatement. That result in financial statements to be materially misstated. So management makes certain assertions. And if auditor believes that there is a reasonable possibility that it may contain a misstatement, as a result, financials will be misstated. For example, management asserts that inventory value is $100,000. When management states that inventory value is $100,000, management is making a valuation assertion regarding inventory. Now, valuation assertion regarding inventory, is this a relevant assertion from the auditor's perspective? So is there a reasonable possibility of containing a misstatement in this assertion? Yes, there is a possibility. It is very much possible that value of inventory is not $100,000, but value of inventory is $50,000. There is a possibility. There is a possibility that inventory is obsolete, outdated, rotten, maybe damaged, but management has reported it at $100,000 when its value is very less. There is a possibility that inventory is overstated. Now, is this valuation assertion relevant to the auditor? Answer is yes. Why? Because there is a reasonable possibility of containing a misstatement in valuation assertion. So auditor is concerned primarily of relevant assertions. Suppose bank balance reported as on December 31st, year 2 is $50,000. Now, when management states this, it makes various assertions. It makes assertions regarding existence. It makes assertion regarding completeness. It makes assertion regarding valuation. And it makes assertion regarding rights and obligations. So when management states that bank balance is $50,000, management states that yes, this is what we have in our bank account. This actually exists. It is not that our bank balance is $10,000, but we are reporting at $50,000. It is not that. Management says that we actually have 50,000 in our bank account. All right. So when management states that bank balance is $50,000, it makes an existence assertion that we actually have $50,000 in our bank account, in our checking account. When management states that bank balance is $50,000, it makes a completeness assertion. That is, we have not missed to report any amount that should have been reported as bank balance. If organization has multiple bank accounts, management says that, yes, we have included balances of all the 4 accounts. The total of all the accounts comes to $50,000. This bank balance is complete. There are no misses. Is it a relevant assertion for the auditor? Yes, it is relevant. Auditor will check what management is asserting. Management is asserting that this $50,000 exists in bank accounts. Auditor will check this. Relevant. Management makes a representation that bank balance is only $50,000. It is not more than that. It is not that they have missed anything. Completeness assertion. Auditor will check this. Answer is yes, this is a relevant assertion. Management make an assertion that value is $50,000. Now, if bank balance is $50,000, there is no question regarding its valuation. Question regarding valuation comes for inventory. Question regarding valuation comes for property, plant, and equipment. But regarding bank balance, there is no question regarding valuation. If bank balance is $50,000, it is $50,000. There is no question regarding valuation. Not relevant. This is not relevant. This is not relevant assertion. Management asserts that they have right to this $50,000. There are no claims against this. Yes, this is relevant. So auditor will check these assertions. But regarding valuation, it is not that relevant to the auditor because there is no question regarding valuation. The possibility of a misstatement in this assertion does not exist. There is no possibility that it is misstated. If you have any questions, please ask me. Okay, so auditor is concerned about relevant assertions and how the auditor considers assertions during the audit process. So auditor has to assess the risk, that is risk of material misstatement at relevant assertion level. So what all are the relevant assertion level? Auditor has to see, has to identify what are relevant assertions, what are irrelevant assertions, and at relevant assertions, what is the possibility of risk. So he has to assess the risk at the relevant assertion level. Let me give you an example regarding inventory. Management states inventory balance at $100,000. And when management states inventory at $100,000, it make various assertions like existence, completeness, valuation, and rights and obligations. All right. So when management reports inventory at $100,000, it makes various assertions. All the four assertions, that is existence of inventory actually exists, inventory is complete, inventory value is $100,000, and organization actually owns this inventory. All the four assertions are relevant. And when all the four assertions are relevant, auditor has to assess the risk for all the four assertions. So auditor, for example, may assess that risk regarding existence of inventory is high. So auditor assesses that, let's say, risk is very high regarding existence. Why? Inventory items are small and costly. For example, microprocessors. So microprocessors are small and easily transportable inventory items, and they are susceptible to theft. So there is a risk that those items are stolen and do not exist in the inventory. Also, inventory is held at locations outside the entity. Also, stock taking is done by just one person in charge of the warehouse. Because of this, auditor feels that there is a high risk that some of the items do not exist. There is a possibility of theft. Items are costly, small, easily transportable, can be easily stolen. There is no proper security at warehouse. Sometimes issues are done to various departments without proper entry in the issuance register. Record keeping at the store or warehouse is unsystematic. Stock is not arranged properly, etc. So for various reasons, auditor feels that risk regarding existence of inventory is high. Although management has reported that there are 500 items, but there is a possibility that number of items actually in the warehouse are less. All right. Now, auditor assesses the risk regarding completeness. So management says that these items are complete. It is not that we have missed any item. It is not that we have more items of inventory, but we have reported only 500 items. No. So management makes a representation that they have 500 items. They have inventory of 500 items, and this is complete. An auditor assesses risk at a lower level. Based on his prelim view, he feels that risk regarding completeness is low. Regarding valuation, inventory valuation $100,000. Auditor assesses risk at a very low level. Why? Based on inquiries and analytical procedures, he feels that risk regarding valuation is very low. So there are proper standard operating procedures regarding valuation. Valuation is done at senior management level and is reviewed at two levels. The staff who is doing the valuation is competent. He feels that risk regarding valuation is less. All right. Management makes an assertion regarding rights that they actually own this inventory. Auditor feels that the risk regarding rights and obligation is high. Why? Because auditor inspected various documents, minutes of board meetings, terms of sales, and find that there are many consignment transactions and many bill and hold sales. Because of that, there is a risk that the organization has reported inventory but does not actually own that inventory. So there is a risk. All right. So auditor assesses risk for all relevant assertions. Now, we are talking about auditor's consideration of assertion. From auditor perspective, auditor has to assess the risk for all the relevant assertions and design and perform further audit procedures in response to assessed risk at the relevant assertion level. So auditor initially assess the risk, and basis this risk assessment, auditor will design and perform audit procedures. You call them further audit procedures. So auditor assessed risk. When auditor assess risk, this is by performing risk assessment procedures. So auditor performed risk assessment procedures. For example, auditor made inquiries, auditor visited the inventory warehouse, auditor observed a lot of things, auditor talked to accounting staff, auditor inspected various minutes of meetings, various terms of agreement. So auditor performed various procedures for risk assessment. These procedures are risk assessment procedures. So auditor performed various risk assessment procedures so that he may assess risk at the relevant assertion level. Now, once the risk is assessed, auditor will design and perform further audit procedures. So when auditor performs risk assessment procedures, auditor assess risk. Auditor assess risk at relevant assertion levels. Auditor also assess risk at financial statement level, but we are not discussing risk assessment at financial statement level. That we will take in another session. So we are only talking about relevant assertion level. So by performing risk assessment procedures, auditor assesses risk, and bases this risk assessment, auditor designs and performs further audit procedures. Now, how this risk assessment forms the basis in designing and performing further audit procedures. So auditor assesses risk regarding existence of inventory at a higher level. Now, because auditor assesses high risk regarding existence of inventory, accordingly, auditor will design and perform further audit procedures. So high risk, more procedures, more strict procedures, evidences, more persuasive evidences, more number of items will be selected from inventory list for checking. So auditor has a list of 500 items that management provided, but he feels that yes, out of these 500 items, many items may not actually be in the warehouse. To verify the existence assertion, auditors normally select items from this list and check whether they exist in the warehouse or not. Now auditor will select more items from the inventory list. So earlier, if auditor normally would select 10% item, that is out of 500 items, 50 items auditor selects and checks whether they exist in the inventory warehouse or not. In this case, risk is high. So auditor will not just pick 50 items from the list, but will pick 150 items, 30% items. Why? Because the risk is high. And because the risk is high, it has impacted auditors' further audit procedures. So because the risk is high, auditor himself will observe physical inventory count. Because the risk is high, he will get confirmation of inventory at locations outside the entity. So he will get a confirmation from all the warehouses that are outside the entity, that are with third party. So inventory with third party, he will get a confirmation from them. Because the risk is high, accordingly, he will design his procedures. Accordingly, he will select the sample size, number of items to be tested. So his risk assessment determines further audit procedure. Auditor assesses risk regarding completeness of inventories. So auditor assesses risk regarding completeness of inventory at a low level. Now, because risk regarding completeness of inventory is low, auditor does not need a lot of evidences. Auditor does not need very persuasive audit evidence because the risk is low. Auditor feels that if management has reported 500 items, the possibility that management has missed some of the items is less. So auditor will select a sample of inventory items from the inventory warehouse and see whether those items are in the list, because to check the completeness assertion, auditor normally make sure that whatever items are in the inventory are also on the inventory list. So auditor selects a few items from warehouse, pick up their tags and checks whether those items are actually on the inventory list or not. So auditor has to select a few items from the inventory warehouse and check whether those items are on the inventory list or not. Now, because the risk is low, so auditor will not select a large sample. Auditor will only take a small sample. Any questions? So risk assessment determines auditors' further audit procedures. How more procedures will be performed? That is determined by risk assessment. Okay. Auditor also assesses risk regarding valuation at a very low level. So risk regarding valuation is very low. Because risk regarding valuation is very low, auditor will not perform lot of procedures, does not need very persuasive audit evidence because risk regarding valuation is low. Auditor will analyze production cost, examine quotations, prices. Auditor assesses the risk regarding rights and obligation at a high level. Now, because the risk regarding rights and obligation is at a high level, auditor will do extensive testing. He will take a larger sample size. So he will examine consignment agreements. He will examine bill and hold agreements. So again, how the auditor considers assertions. So auditor assesses the risk at all the relevant assertions. Auditor is not concerned about irrelevant assertions. Auditor assesses risk for all the relevant assertions. How auditor assesses risk regarding all the relevant assertions? By performing risk assessment procedures. We will discuss risk assessment procedures in another session. But auditor performs certain procedures. You call them risk assessment procedures. Through those procedures, auditor assesses risk for relevant assertions. After auditor has assessed risk for relevant assertions, auditor designs further audit procedures. So if risk is high, accordingly, auditor will design further audit procedure regarding that particular assertion. If risk regarding a particular assertion is low, auditor will accordingly design and perform audit procedures. All right. All right. So that's all for today's session. Hope this session was meaningful and useful. We'll connect again when we take audit risk, audit procedures, and audit evidence. So have a great day and have a great week.
Okay. Thank you, sir.
Thank you,
Thank
sir.
you. Take care.
Thank you.
Thank you, sir.
Thank you.